Good morning, YouTube. Let's talk about options today, as we usually do. But this time we're going to talk about how we pick our options because that's probably the most common question I get. How do you pick what you're going to buy or sell? Usually sell in our case, of course, as option sellers primarily. So it starts with, well, you've got to pick two things really. You've got to pick, or I guess three. You've got to pick pricing, option expiration, and your entry point. So those three things are the things that we'll talk about in this video today. And you can see that I've started off here with my watch list. So it doesn't matter what's on your watch list. And I've said this before, it changes all the time. We're pre-market, so right now everything's showing zero. But as an example, I'll show how I chose an option yesterday. And that was on a company known as ASTS. Now, why did I pick ASTS? Well, yesterday, ASTS was pretty red. The reason they were red was they just had earnings. In fact, if you looked at the earnings, and we'll go to the 5-day here, you can see that they had a run-up prior to earnings that looked pretty good, and then they dropped dramatically from 27 to 25. I didn't think it was that big of a deal. The earnings kind of came in as expected from what I could tell and what I followed about the business in the past. So in my mind, this was potentially a good options play. But you can't just jump into it from there. I mean, you can, but usually it's best to do a little bit more due diligence on it, or DD as they say on the internet. So number one is we want to start with the watch list. Number two, we want to look at, is there recent earnings or earnings coming up? Because that's going to drastically change your volatility, which ultimately turns into premium. So here we are looking at Market Chameleon. That you can choose any website you want. This is just the first hit. So I took a quick look and it shows that we've got an IV of 85.1. which is a little bit lower than what it's been. It's in the 10% and it says subdued. I don't actually know what subdued means. Fancy word. But here they give a little bit more information on the IV rank. And it says it's in the 10th percentile rank, which means only 10% of the time the IV has been lower than what the current level is. Now, that means that overall it's pretty high. And in general, anything over 50% is pretty high. And over 80% is considered extreme. So implied volatility is, of course, the risk that you take with the business to go up or down. One of the other things that I like to look for is what is the implied move? So if something is going to have earnings coming up, you can look to see what is the expected move of the stock. So if we want to look at that, I just searched for the same thing, except I typed in ASTS implied move. And once again, we have Market Chameleon at the top, not a plug, not sponsored by them. But you can see that they typically have a move of plus or minus 14.5% predicted, whereas the actual move is only 2.2%. And it's very interesting how they give some additional information around the percent of times that they actually overestimate the move, that being the market. And they tend to overestimate it on this stock 62% of the time. Okay, so that was before earnings, but we're actually looking at it post-earnings. So in the post-earnings case, my decision-making process looked like this. Earnings weren't terrible. They were kind of what everyone expected, but there was a run-up to earnings. So we dropped down to 25. At this point, I said, you know what? I think this could be a good entry to sell cash secured puts, not owning the stock myself right now. So that's what I did. And I headed over to the options chain where I started to look at what are my options. And this is for ASTS. This is from the close of yesterday. So it's actually not perfectly accurate yet. We'll get that in about 10 minutes when the market opens. But until then, still a good example. And I can tell you what I actually did in a real life situation anyway. So I looked around here and I said, okay, this is interesting because we were at about this range, actually. I think it was about 26.5 was the price. And it had dropped down to 25.94. In that range, I decided that 25 at the time was a delta of like 0.25. And I thought that, okay, that seems pretty safe. And the premium was pretty good. So that is an important thing of what is the premium, of course. And if we looked at this on the trade analyzer, which to be honest, I don't use all that often, but it'll be helpful for this case in terms of showing that what's the estimated max gain and what is the probability of profit. So 85%, it was probably closer to 80% at the time, but knowing that earnings had already passed, it was unlikely in my mind that we were going to drop down below 25. And I actually sold this option at 60 cents a contract, which means that my cost basis would be 24.40, which is good downside protection to go even further. And if you look at that, right, we're in here it shows the delta is in the 15% range, but at the time, I think it was probably closer to 20. Anyway, when I was looking at this, I said, okay, so let's do a little bit of quick math and make sure that we're getting paid on this. For 60 cents or $60 per contract, divided by the amount that the stock would cost me to sell the contract on, which in this case would be 25 times 100, so $2,500, was 2.4% return. Now, on a week-by-week basis, that's actually pretty good. To show that that's good, we look at the APR, which is an annualized percent return. And if you want to annualize a week-long DTE experience, you multiply that by 52 weeks in a year to get 124% return. Of course, if you actually looked at the number, it was probably a 3-day DTE, 3 days to expiration at the time. So if you really wanted to make yourself feel better about it, you could take the 024 and multiply that by, I don't know, something like, what's 240 divided by 3 is going to give you 80, right? So almost a 200% return APR technically, but I like to keep it in the weekly range because the fact is, if I'm not deploying my capital every day, that's a little bit of an overstatement to say that it's a 192% return. While true, it's just something that I like to be a little bit more on the conservative side. However, 2.5% return on a weekly option is something that I generally look at favorably on. The fact is, anytime you're getting over 1% or even 0.5%, you're beating the S&P on average for the best years that the S&P's ever had. And if we were to go back and look at the historical, we can prove that pretty easily looking at the S&P 500 returns over the course of a year, and any given year, all the way back to 1927. Wow, 1931 was bad. Good thing we weren't here around that. However, a couple years later, 54%. Now, if you're seeing a 1% a week return on your deployed capital, guess what? You're about at the highest level ever recorded for the S&P 500 returns, 52%. I would say that's pretty good. Generally, this is very high where we've been in the last few years, and even still, at 0.5%, you're keeping up with last year's return on the S&P 500 at 25.02%. Now, my personal experience has been in this extremely volatile environment that selling options can generate you at least 1% in returns. However, you have to keep in mind there's obviously risk in doing that, and you have to be very choosy on what options you're choosing. So we're going to go back to where we were just a moment ago looking at the option chain here, and there was another part of this that I found pretty useful, and that was, number one, open interest. And at the time, the volume was in the multiple hundreds, something like, I think it was 360, something like that. So how many contracts had been moving in the last few minutes? So between those two things, I was interested in the $25 strike price. So how do I feel about the stock is really the next question. And overall, I feel pretty good about ASTS. They're pretty well known. They've got a lot of contracts. They announced that they had contracts. So at that point, it's good to do a little bit of news hunting and just see what has happened recently. Now, you can do that in a few ways. You can either, one, go to their website very simply and look at the investors typically to see what are the things that are going on. Press releases are a good place to start, and it's up to you how in-depth you go here, but you might just look to see what are they announcing here in the recent past. And when you see things like there's an agreement signed or a contract with dollar values behind it, that's a pretty good sign that, hey, the company is making money, it's doing things, And then the other side of it is you also want to look at recent financial results. So you might look at quarterly, might take a glance at annually. That can be a very scary number, but if it can be explained away, it's not necessarily a big deal. So you might go as far as digging through past earnings presentations. What did they promise in the last earnings call that you should be thinking about for this earnings call? And is it probable that they can beat those analysts' expectations? From there, I go back to where I was, which is the option chain, and I'm taking all this into consideration. And I go, okay, well, we know the implied move, the implied volatility. Generally, it looks like the company is doing some good things. I feel pretty good about it. How much do I want to risk? And what is the best value that I can get? Now, the best value you can get is at the money. You're going to get the highest level of return on the premium the closer you are in delta, right? So as we get to this 0.5 delta, you'll see pretty naturally those are the highest value, highest probability contracts, because that's the highest risk for the option seller and the lowest risk for the buyer in that case. So you're going to pay more as a buyer for that, and that means that the seller obviously is able to sell that for more as well. However, I didn't really have a good feel for how far we would go in this case. So I said, I think I'm going to be a little conservative, and I stuck to the 0.2-ish delta area, sold my cash secured puts on that, but not until I did a little bit of TA on that. And what TA looks like to me is you can take a quick look here, of course, at the chart. I like to look at the 6 months. Are there any giant dives that align with any big news or things that we should be worrying about now? In the case here, I remember this actually being some sort of negative news, and everybody was like, oh my God, I can't believe it dropped so low. And anyone who bought it there was pretty happy as it doubled in price that literally like a week later. Sometimes I'll look as far as the 1 year. I will say that with how the valuations have looked over the last year, the first few months to that 1 year look often look like it does right here, where it's much lower and then it spikes up. In the case of ASTS, well, their company didn't really start making big moves until 2024. And since then, they've been in this trading range over here. Very light TA for sure, but it's all dependent on how in-depth you want to go. You can also head over to either TradingView or Trading Desk or whatever they're called and take a look at some more in-depth things. This is Robinhood Legend. And, ooh, I guess the market just opened. That's cool. I didn't expect that to happen on the video. But often what I'll look at here is the RSI, right? Are we looking at a position where we're in an oversold territory? I'll zoom out here a little bit as well. You can look at, say, the 3 month on, we got to do a bigger candle than that. We'll look at the 1 day and see how that looks. So the last 3 months, it can help you get a range for where things are. I like the Bollinger Bands to get an overall view of, are we expecting a big move? Are we expecting a small move? We're actually in a fairly tight range compared to where it's been if we look at the last spike up. So things feel somewhat stable. And post earnings, which by the way, that's what we're seeing right here where we went out of the Bollinger Band on the top side. We also have our moving averages. If we're in the general vicinity of all that, it seemed pretty safe that, 25 was a good strike price for this particular option. And if you look at it, that's basically where all of the moving averages are right now. The 50 is exponential moving average is going up a little bit now, 26, 24. Oh, that's because of what I'm what I'm hovering over. Sorry. Everything's just about 25, right? And that made me feel pretty confident that 25 was a good price. And already, this is kind of funny because we're looking at it and we're up so far for the day. The first couple of minutes don't mean anything for the day, by the way. Who knows what's going to happen by the end of the day, just looking at the first minute. But it's not a bad sign that we're opening a little bit higher. And so my $25 strike is all of a sudden looking quite a bit better. So if we go back to the option chain, I'm going to actually refresh this. And let's take a look. Yeah, that was the close of yesterday. Let's take a look at where we're at now. and they're already down to 20 cents. So I might actually buy this back. I know this is a little bit of a tangent, but we might as well take a look at it. If a good place to buy back is, especially the next day on a weekly option, is going to be something like 80% of the value. So at $60, if we were to look at what point 0.8 is, 48, right? So that means that 0.12 or better is not a bad buyback price. And on Fidelity, which is where I sold these contracts, anything under 65 cents a contract's free. So I'm actually incentivized to buy that back if we head back to that direction. But anyway, that was how I came about looking at the stock. Now, the next point is not the stock, but the world or the sector that we're in. And real simply, what's going on in the world? Now, why did I pick a week? We didn't even cover that yet. How come I wasn't looking at May 30th or well, actually, May 30th isn't really that good of a date. If anything, I'd be looking at probably June 20th, where we're on the third Friday of the month. That's going to give us better volume for what we're going to see versus June 13th or June 6th. Doesn't mean you can't sell those, but like as an example, the $20 strike for ASTS on the 20th is almost 7,000 open contracts. If we were to look at June 13th and June 6th, I'd be surprised if we had similar volumes there. So if we look at the strike prices from 20 to 30, you'll see there's hardly any volume over here. Open interest for June 6th is 113. Open interest for June 13th is 59. Boom. We see it on the third week of the month because that's where monthly options originally start, is the third week of every month, to avoid things like quarterly close, report outs, big earnings, other big financial events. That's just how they started. So with that, I decided that, with the volatility and the premiums that we're seeing, I like May 16th. So I went back and I said, okay, that $25 strike, which is, wow, down at 0.13. I really need to look at buying that back here in a couple of minutes. That's what I'm going to sell. I feel pretty good about it. From that kind of pairs with the delta, right, in terms of what percent chance do I have for profit. And you could see it was like 0.13 or 0.15. It continues to drop as the stock price goes up. So that's how the delta changes. Although the IV has actually gone up as well for that one, which is kind of interesting because it was only like 108 or 105 or something like that when we first looked at that. I think that's just from the movement that we're looking at. And then finally, the last piece of it was, what is the price that you want? Now, when I was looking at this, the sell option was listed at something like 0.55. And I said, that's a good price. There's nothing wrong with that. But based on what was happening, I said, I think it seems likely that I could sell this for a little bit better price. And I put a limit sell in for 0.6. And I think that's important. You got to understand that just because it says right now 0.13, well, 5 seconds ago, it was 0.2. And yesterday, it was 0.4. So that's constantly moving and recalculating. You need to decide, and that's the beauty of selling options. You get to decide what's the price that you want to sell at. And for me, it is a 2.5% return is typically what I would love to shoot for on average. Sometimes you do better. Sometimes you can get 3%. Sometimes you go 1%. It depends on how far out you are from the strike. It depends on what's going on with the stock. There's a lot of things that go into that formula that you can look up if you want to get into that detail. But overall, that is how I ultimately settled on $25 strike. Sounds good to me. Very low risk, some downside protection as low as $24.40. And I'd be happy owning the stock at $24.40. Now, that's the last golden rule. I always call it the golden rule is you want to do this on stocks that you're happy to own should you get assigned. Because if I get assigned ASTS and the price drops to 20, I have to be okay with that. Otherwise, I'm going to be crying myself to sleep every night. No, you want to pick the stocks that you believe in long term. And I think ASTS has got a great trajectory. Satellite joke, rocket joke, I guess. Anyway. That's how I decided on ASTS. I hope that gives you some insight into things and ways to think about how you might consider choosing a particular stock. I didn't go real deep into the TA side of things, obviously. any single one of those things, you can go as deep as you want. Just know that no matter how deep you go, you can be wrong. So have conviction in your plays, but also you need to know that there's a limit to how much TA is worth doing. So find the things that work for you. Maybe some of these do. Maybe there's some other things that you do that I didn't mention here. If there are, put them in the comments below. I'd love to hear about them because maybe it's something that I could improve on and make a future video on. So hopefully that helped. See you in the next video. Thanks for watching. Bye.